This is the IBJ podcast for the week of March 13th, 2023, brought to you by Taft. I'm your host, Mason King. Welcome back to the podcast, everybody. The word on the street is that the Federal Reserve is going to raise interest rates again next week as it continues to try to cool inflation. It's hard to think of anybody who would be happy about that. But the silver lining is that when lending rates rise, savings rates also rise. It's not unusual now to see certificates of deposit with 4 or 5% annual yields locked in over 12 to 24 months. Money market accounts are now paying healthy returns as well. You might want to point this out to your Millennial and Gen Z friends because they probably haven't experienced interest rates this high for savings in their adult lives. As we've discussed on the podcast, it's difficult to get many Americans to put away an appropriate amount of money for retirement or a financial emergency. Late last year, your friends in Congress passed a significant revision to the rules for retirement plans with the intent of extending and expanding your savings opportunities and ability to save for retirement. And it's not just for folks preparing to hobble across the finish line. The changes can also help people still paying off their college loans or those who need to establish their first emergency funds. For this week's podcast, I've invited IBJ columnist Pete Dunn, aka Pete the Planner, to explain these new opportunities for savings. And as it happens, his column this week has a slightly different take on saving money that follows one of his primary maxims: the easiest way to save money is to not spend a lot of money. In this situation, he's talking about trying to level up in the housing market and trading in a 3% mortgage for the Fed's new inflation-fighting rates. Here's our conversation. I am happy, as always, to welcome back to the podcast, Pete Dunn, a.k.a. Pete the Planner. How are you doing?
I'm just happy I've not been replaced by AI on these segments. That you still go to me instead of like Chat GPT. I guess I can be Chat PTP. We'll call me that for today, and I'll answer. I'll just promise not to threaten you or whatever.
This is one of the reasons why I feel good about my job, is that I don't think there's a chat whatever bot that could sound so ill-informed as I do.
You play that part to perfection, Mason. It's great to be with you.
Thank you. Thanks for approving of my core self-esteem. Oh, okay. Here's a good thing too. I'll give you an update on this, even though that you have professed in the past not to care.
Yeah, I don't.
So my wife and I, we have been meeting with a financial planner, and we are getting our disparate investments together and moving in like a thoughtful direction.
I care about that deeply.
You said you didn't care the last time we talked. You said it was putting you to sleep.
No, I think that's great. I like progress, so that's good. Good for
it's
you.
Progress.
You feel good about it?
I feel pretty good about it. One of the things that is really great about it is my wife finally got me to release my iron grip on the cash that we had that was sitting basically in our mattress, and is now getting like 4%.
Look at
4%. It's in CDs mostly, and also some of it's also in a money market. 4%. I had no idea that was even available.
Sounds like I should be interviewing you, and I'll be the quirky host.
Okay, I put too much energy into preparing for this episode, so let's just do it the normal way.
Okay.
So the theme I think this week is going to be savings. We're going to look at a few changes in the financial environment that can put you in a position to save more money and or generate more money from your savings. So probably the easiest one to understand is from your column this week at IBJ. And it feeds right into one of the primary Pete the Planner maxims. The best way to save money is to not spend a lot of money.
Did I say that? Is that a PTP maxim?
I'm paraphrasing, but come on, tell me that's not one of your major things.
Kinda. Yeah, it is. So here's where I'm at. I was at a party last weekend. No one was socially distancing, and I can't believe I was invited. And someone brought up the fact that, are we thinking about moving anytime soon? And I had like almost a violent reaction to this. Mason, I have a 2.5% 10-year mortgage. You would have to drag me kicking and screaming out of that mortgage contract because it's not going to happen. I find that 2.5% mortgage is one of my greatest assets that I own, and I will not get rid of it until I have to. And so that is to say, I wrote about this week, who are all these people? They sound like Seinfeld. Who are all these people who are moving with 7% interest rates, getting rid of 2 and 3% mortgages? I don't get it. I don't understand.
Yeah, me neither. My wife and I, we're kind of in the same boat. About 9 years, we refinanced to a 15, and I think we got like 3%.
Right,
and I love it.
Well, so there's
one of the great pleasures of my middle-aged life is just thinking about how much money we're saving.
Yeah, so there's a few different elements here that I think are worth covering. Let's start with the numbers first. Of course, if you've got a lower interest rate mortgage payment, you're going to have a lower payment. Your cash flow will be significantly less than moving to a 7% interest mortgage. And in many cases, you buy more house. And so your mortgage itself is bigger. The second element, which is a little bit longer term, the cost of the overall mortgage, whether it's 10 or 15 or 30 years, in some cases can be 2 to 3 times the amount of interest in terms of dollars that you will pay. An example I was giving in my column, for a 3% mortgage for 30 years on a $300,000 loan, that's 300 times 3 times 30 years. That's $150,000 of interest over the course of that loan. And at 7.25%, which is about what you can get now on a 30-year mortgage for that same $300,000, Mason, that's $436,750 in interest, nearly 3 times the amount for the exact same house.
That sounds like a sick joke. I mean, why are people doing it? That's a great question.
Okay, which goes to my third point, which I think this is where it gets a little heady. So I don't know. Hopefully you've got plenty of coffee today. Clearly I have. I think I'll group myself into this. We hate no. We hate you can't. We hate you can't figure this out. And so these ideas that 20, 30 years ago were objectively bad ideas are still objectively bad ideas, but we now view them as subjective. And it's like, well, it's not a bad idea if someone lets me do it. So I think people are gaining validation in other people's approval of bad ideas. And look, of course, there's good reasons for some people to move right now. I'm not a complete moron. Partial moron is what I am. I don't believe that it makes a lot of sense for someone who doesn't need to move, and it's got a low interest rate mortgage. I think it makes 0 sense to move right now.
Yeah, I think the American ideal, too, is to move into the bigger and better place as your means increase. And again, if somebody will lend you the money.
The housing market's got to be at some sort of a stalemate right now where it should be, where housing prices are kind of coming down a little bit, or they aren't increasing as aggressively. Yet, because of interest rates, people should feel frozen out of the opportunity to buy. That was the intent of the Fed when they increased the Fed rate. I mean, that's the whole point of calming and cooling the economy, was to make people go, should I really be borrowing money right now to grow the economy even further? And the answer should be, no, I've got a 2.5% mortgage. I'm not getting in deeper. I hate to say it. I'm doing my part to keep the economy cool.
Yeah, I forgot to introduce that idea. The reason why the interest rates are higher is because the Fed, starting about 15 months ago, went on a campaign of raising interest rates, among other things, to cool down the housing market, but also to get rid of inflation.
Yeah, right. Well, related. And then you even look at what's going on in the used car marketplace and the new car marketplace, automobiles in general, similar sort of feel. It's actually working a little bit better. You're seeing car supplies, new car inventory increase more than necessarily housing inventory. So it's working. And this is my opinion. It's working in transportation. Housing, people are having a hard time saying no.
I did a little bit of background research. I thought it was interesting that, for people who have been in the housing market for many years, somebody who maybe bought their first house 30 years ago, their interest rate was maybe, could have been 12, could have been 11, could have been 10. I think during the Reagan administration, that went from maybe like 16 to 10. So 7 probably doesn't seem that bad to them.
That's a great point. I mean, it's an incredible point because 6 or 7% over the course of the last few decades, not that bad. Not that bad. And that's why I would say if you're a renter right now, then you can justify making a purchase because you're like, man, 6 or 7% is not that bad. We're not guaranteed to go back to 2.5%. But if you have a mortgage and it is low, that's where I have the struggle. My first mortgage in 2000 was July 2000. I want to say it was 8.5%, but I was also like right out of college. So I wasn't probably that credit worthy, but it was like 8.5% in the year 2000, which again, higher than what we're dealing with now.
Yeah. When I bought my first condo, it was probably 2003, and I was overjoyed that it was 5.85.
Yeah, exactly. You didn't ask, but I will ask myself, Pete, do you believe interest rates will return to that 2 to 3% range? Thanks for asking. Not necessarily. I don't think there's a path there, an intended path there. I think they will settle between 3 and 4%. But I think it was government intervention and it was stoking the fires of the economy, which got us to 2 to 3%. So, I don't think we get back to 2% range.
I'm going to throw in a caveat here because a lot of folks in my family, not me, notably, you're active in like high-end real estate. And I think a lot of those buyers, a lot of them are paying cash.
Right. And on the surface, especially in this environment, I have no problem with that because the opposite is actually true. What you saw 2 years ago is you saw people who could buy in cash say, forget that. I'm taking the 2.5% loan and my cash, I can put it to work a little differently. But it's weird how certain economic conditions can present opportunity to a person who's put themselves into a good position. And what I guess maybe we close the housing thing on this. What I'm concerned about right now is the unforced errors of leaving a low interest rate mortgage for a highest interest rate one because you're like, well, it's what we want to do. It's like, no, that's objectively a horrible idea. Call it whatever you like, but it's a horrible idea.
Well, let's talk about something a lot easier. Cash, I want to stash in savings. So
sure.
Let's say you've got your 2.5% mortgage. You've been trimming your expenses. Now you've got a cash surplus every month. Maybe you have some cash in the savings account already, maybe a traditional bank savings account or money market. So I would say probably the last 15 months in coordination with the Fed, you can now get 3 to 4%, I'm guessing, so I'm told by my financial planner, on your savings when, 15 months ago, it was negligible.
Yeah. 4% is pretty easy to get right now. Just wild. Like it's relatively easy. Now, your local bank may not have 4%, but there are a number of insured and credible institutions that you can access via the interwebs at 4%. And I'm sure there are local banks and credit unions that are doing it too. But I want to have a point of distinction here because I think there's almost like 2 tiers of savings. I think on some level, your first tier of savings, which is the true emergency fund, like, oh my gosh, I'm going to need money like super fast. It should be so liquid and transferable into your checking account that the amount of interest on it, I don't actually care. And it shouldn't also be that much money. Now, beyond that, beyond 2 months or whatever, 3 months, whatever is saved, by all means, subject it to an interest rate, like get it at 4%. I'm just not one of those people that are like, hey, you have $2,000 to your name, you better get that at 4% or you're an idiot. It's like, well, no, the $2,000 is better served protecting you from the downside, Yeah.
That was one of the hard lessons that I learned in conversation with our financial planner. Just you don't have to have your savings all in one place. And so, I like to think about all of our savings as being our emergency fund. And they got me to think about it as we can have X amount of money in the savings account that can be the instantly accessible money. And then we can have money in a money market, or you can a slightly better return in a CD where maybe you necessarily aren't going to touch it, or you can touch it maybe for a few months, but it's there and it's picking up interest.
Yeah, I would actually think about this like a deep freeze or a freezer at your house, where there's certain foods that if it's in your freezer, you probably aren't going to be able to eat it today because it needs to thaw properly. And so then you put it in the fridge and then it comes out to room temperature on the counter. Like, it's the same thing with savings. You can have something in a deeper freeze that takes time to access. And then can last longer. I mean, the metaphor just goes on. And then there's the fridge, and then I'm going to bail on that one.
That's okay. I was following you the whole way. Oh my God.
I don't know. It started to feel like it fell apart, It just went cold.
This was interesting. According to Forbes, one of the guys at Bankrate says to expect the top yielding savings and money market rates to hit 5.5 annual percentage yield by the middle of this year. And then maybe, things may cool down a little bit towards the end of the year, but that's still going to be out there.
So let's talk about who this is ideal for. Okay. So this is where this gets fun. It's ideal for me. It's a deal for someone that has a 2.5% mortgage, and then they can have the spread by having their savings instead of paying off their mortgage. Their savings can earn 5.5%. Here's who it stinks for, Mason. It stinks for the people who just bought a home at 7% and they're getting 5.5%. They're like, wow, look at this 5.5% interest rate. It doesn't matter because the spread is backwards. So that's now, don't get me wrong. You would love the 5.5%, and it's not like you're going to just pay off your house because you don't necessarily have the cash for it, but it's less advantageous for that person that has a higher interest rate associated with their debt.
For folks who aren't, really conversant in this stuff, let me just make sure I understand the options. So you could get a savings account at your bank, and that would pay you whatever they're paying.
Sure.
What is the difference between, say, a money market account and a CD?
CD has a set time frame, 6 months, 3 months, a year, 3 years, where a money market is much more liquid than that. That's the primary difference. A money market is more akin to a savings account. Sometimes a money market account is also FDIC insured, which is great. Sometimes money market accounts are not. They are, I'm using air quotes here, listener. They are relatively safe investments, uses of savings, right? Boy, just wait until you and I are both in court over that. But you know what? We spend so much time together on this podcast that we'll have each other's comfort in that.
Oh, that'd be great. This is like the last episode of Seinfeld where they're all together in the who's
we're Thelma and Louise, you and I, driving off the cliff. Anyway, I think that money markets are generally fine. If they're FDIC insured, even better. And they're very similar to a savings account that way. A CD is just, it's fine. You just have to commit your money for a longer period of time.
Right. And then is the interest rate then marginally better because you have committed?
Theoretically. Theoretically. I mean, you're like, hey, 3 years for 5% a year. It's awesome. And here's where that actually gets awesome. It's like the reverse of an adjustable rate mortgage is if, let's say, interest rates plummet, might be the better verb there, over the next couple of years, that you're still holding this vehicle that will give you 5% for that year and everyone else is paying 0.5%. You look like a genius.
Okay, let's take a quick break to hear from our sponsor. This is the IBJ Podcast.
Taft, today's modern law firm. With more than 800 attorneys in 8 primary Midwest markets and the District of Columbia, we provide solutions to the business issues facing middle market and emerging companies alike. We do this through a highly collaborative and inclusive team approach. Taft, the modern law firm. To learn more, visit taftlaw.com.
All right, we're back with this week's edition of the IBJ Podcast and my conversation with Pete the Planner about the new rules for savings.
So let's now widen our view then to retirement savings accounts. Financial planners and their clients, I think, are digesting changes to the rules about retirement savings from what we call the Secure 2.0 Act of 2022, which was passed at the end of last year. Secure, of course, is a weird acronym standing for Setting Every Community Up for Retirement Enhancement.
Jeez.
Should be self-explanatory. What was the Secure Act supposed to do?
It was supposed to level the playing field it is supposed to level the playing field for tax advantage savings and to adjust to the nature of longevity. Some of the rules in our retirement system were built back in the 1930s. And so a lot has changed since then. Even this morning, which is a nice way to evergreen a podcast. I was reading comments from Nikki Haley, who's running for president now. And she just outright said, hey, look, we're going to need to change Social Security age for the younger generation. And I'll group myself in there despite the hair loss. And she said, I think at minimum, it's going to have to go to 72 to 75, potentially 80. Right. And I kind of agree.
She said potentially 80?
That's what I read. Take it up with
potentially 80?
That's a bit aggressive.
Okay.
I mean, look, that's a bit aggressive. I think right now it's 62 is when you can take early withdrawal.
Oh, I thought you could take it at 59 and a half. Oh, but you're talking about Social Security, right? I'm sorry.
Social Security, right. Yeah. So there's two different things, right? So, but the whole point is a lot of our retirement system is so antiquated. There has to be changes. I actually support increasing the age for people my age. If you're already in your 50s or 60s or 70s or 80s, by Lord, let's not change that. That seems like a bad idea. Anyway, to your point, Secure Act is meant to level the playing field for the assets that we hold outside of Social Security. And one of those, which sort of dovetails in, is this idea that you won't have to take withdrawals from your account until a later time. These are called required minimum distributions, RMDs, as we call them in the biz. And it's going from age 72 to age 73 this year, and it's not till 2033 when you have these 75. And this is important. I think this actually helps people.
So somebody like me, I've got IRAs, I've got a 401k. I think I've got a profit sharing plan stowed away somewhere. So that holds true for these kinds of investment vehicles where eventually the government has their attitude has been, you can't just hold on to that forever. You need to start taking distributions. And currently, or I should say currently, I mean, as of last year, it was 72. This year it's 73.
It used to be 70 and a half not too long ago. And so now it is, it's 72 going to 73. And it's simple. We need the tax revenue. Congrats on saving. Congrats on the tax deferral. Break us off a little piece of that.
Wait a second. What does that mean?
Break us off a little piece of that. It's like,
no, not that part.
Oh,
that benefits the federal government.
Oh, yeah. The reason the withdrawal takes place is so you have to pay taxes on it.
Oh,
that's the whole reason.
Right.
I thought I turned into your Urban Dictionary there for a second. And then Pete told Mason what it means to break someone off.
Oh, okay. I thought it had something to do with charcuterie.
No, it's,
Okay. So the government wants you to eventually start cashing out because it wants the tax money. But now it's giving you right now an extra year, which is good.
It's good for, it's good for savers, investors, and arguably is potentially contributing to some of the tax revenue problems that the government will continue to have. I don't know. I mean, it's good for us, but is it, I'm not getting political. It's good for us now, but is it good for us then? Because then the tax revenues get thrown off and we go deeper into a deficit. I don't know. That's not my thing.
Now, maybe kind of a corollary to this, if that's probably not the right use of the word, but it's related. Also this year, the penalty for failing to make your required withdrawal has decreased. So it's even saying like, hey, if you don't do it, we're not going to ding you as much.
I have to say, as a former financial advisor, not that I was kicked out of the industry for failing to make people take required minimum withdrawals, but I will say this, it's so common to forget your RMD. I mean, it is crazy common. And financial advisors, if you have one, they should keep you attuned to when you need to take them. But it's really common. And I think they just acknowledge that. And they're like, we're crushing people for a pretty easy mistake.
And additionally, Roth accounts in employer retirement plans will be exempt from RMDs starting in 2024.
Yeah, this was silly that it wasn't exempt in the first place because it's after tax money. So this was like an oversight that they just cleaned up. It was sort of nutty. I will say one of my favorite rules that have just changed, and it's coming in the next year or so. You like the specificity of the time frame there. A person will be able to roll over up to $35,000 into a Roth IRA from an unused 529 college savings plan. I think that's fascinating.
Okay. So I've got a son who has a 529. And it's pretty well funded.
He'll get a billiard scholarship, so he won't need all the money you saved. Like he's good at 8-ball or 9-ball or whatever they call it. Snooker.
Okay. He is.
Okay, of course he is.
Okay, he is, because we do that around the house. But right. So he's got, so he doesn't need to use all that money. Let's say we have more than enough money in there. So some of that will be able to be rolled over into retirement
for you, for the account holder.
Oh, okay.
So that for 35,
for me.
Yes, that's why I like it. Forget the kids. They're on their
good.
own. For you and me, baby. $35,000, which I think is great, because I think sometimes parents undersave for college with this fear, justified or not, that the kid won't need all that money. Well, this gives you 35 grand back. And that's at least a year of college, right?
Okay. So my son gets a full ride based on his pool prowess at MIT. So we've got all this money sitting around, and it's 529. So 35,000 of that can come back to me.
Yes.
That's outstanding.
I know. And that's sort of buried in all this news.
Suddenly I'm like less interested in my son going to college.
Yeah, same.
Okay, there are more wrinkles here. Higher retirement plan contribution limits for certain individuals.
I will note that it's called a catch-up contribution, and Heinz Corporation's not involved with this. It's catch up. And it means that once you achieve the age of 50 or higher, you can put more money into your workplace retirement plans than people who are 49 years or younger. Right now, it's $7,500. And starting in January of 2025, what's going to happen is if you are 60 to age 63, you can put 10 grand extra in. So another $2,500 a year. But, I have to admit, neat, but incredibly unmeaningful that they're going to let you put away an additional $7,500 over a 3-year period. I'm struggling to see the utility in that.
Oh, I see what you're saying, because you're going to be retiring soon anyway.
Yeah, I mean that the last 25, just so you know, the last $2,500 that you save doesn't matter, which sounds awful, but it's a math trick. It's the first $2,500 that you save that matters. The last $2,500 doesn't matter.
Right. Yeah. But still, I mean, they correctly assume that the vast majority of Americans have not saved that first $2,500, or at least they didn't until they were, middle-aged. And so they're just giving folks a chance, to hit maybe like a hot streak in their investments.
I don't know how they don't call me on these things, but here's how I would have done it. I would have increased that in the 50s, even the mid 50s, like make it arbitrary. You already made it arbitrary, 54 to 56, and let them increase it, because at least the money has time to double. There's a doubling period because it's still growing. I just at the end of the total end of a career, theoretically, it just makes no sense to me.
Really, this only pertains to people 60 to 63.
Yeah, I'll never make it there. That's right.
Okay. Right. So me being in my 50s, I still will be able to contribute that extra 7,500 as catch up.
Yeah.
If I max out the other ways of saving.
Correct.
I have to be able to max that out.
That is a big part of it. Yes.
Okay. Gotcha. And this is interesting. This is for folks who are younger, I assume. Their emergency savings accounts could be established within defined contribution plans, like your 401k, for example.
Yeah, and this is nice, right? This is a good one. I think sometimes when we lower the barrier to savings, it helps people, right? And so if through your employer you can save money and it's all part of it, then it's clean. You never miss the money, and so I'm all for it. I don't think this is a massive game changer, but potentially for the unbanked, people who don't participate in the banking system, which are usually on the lower income side of the scale, this could be meaningful. Although, so you could also argue that the folks in that end of the scale don't have money to save. So I don't know. This feels like a little bit of window dressing, but I'm not against it.
So let me make sure I get this. So starting in 2024, your retirement plan, this isn't mandatory for all retirement plans, but your administrators could choose they give you that option of creating an emergency savings account in addition to the money that you're putting away for retirement. The place where this seemed to be a benefit is that your employer could put matching money into that emergency account. And, normally when you take money out of if we're going to say a 401k again, you have to pay a penalty. Unless you're in your 50s or 60s. And in the emergency savings account, you do not have to pay a penalty for taking that money out.
Yeah, absolutely. There's utility in that, 100%. I would say my gut tells me, which is substantial, my gut tells me that it's going to be really highly compensated people and organizations that are just looking for ways to put golden handcuffs on people to keep them there. That's who this benefits the most because of those extra contributions. But, if you work for a small to mid-sized business, I think it's unlikely that this is going to, significantly impact you.
I love that phrase, golden handcuffs. And I think I've seen it used in relation to this last bit of change in the Secure Act about student loan payments. My understanding is effective 2024, employers will be allowed to make matching contributions to their worker retirement plans for those folks who are still paying off student debt. And they can, realizing that I am putting most of my money back into my loans, they can say, well, if you're putting X amount of money into your loans, we will go ahead and put some corresponding amount of money or a percentage of that money into your retirement account.
Yeah, it's nice. And there's going to be a certain portion of the population this really benefits. What I hope doesn't happen is that then this creates a retirement problem, just plain and simple, because it's the early money going into a retirement plan that's the most significant. And so if this distracts/dissuades people from putting money into the plan because they're aggressively attacking their student loans, I hate to say it, but the math doesn't support that that's the best way to go. The math supports that you are aggressively saving for retirement and then busting your hump to get out of student loan debt too. I don't think you should flip them. I don't think that the number one goal should be to get out of student loan debt. The math just doesn't support it.
But in any event, employers, if they choose, can,
yes,
the way I'm getting it, they can put money into your retirement account based on what you're putting into your student loans.
Yeah, this is certainly not the point of our conversation today, but the more we're sitting here talking about some of these changes, you can see why some of them were advocated for by big business, because it's such a huge advantage. If you're a large business, you can have all of the talent because you can provide all of these things that a small and medium-sized business might be able to match the salary, but they can't match all these benefits, and right. That's the problem.
Well, that was the golden handcuffs thing, I assume. The reference is that, you get into a place where, hey, my employer is helping me pay off my student loans. That's a pretty good incentive or not paying off my student loans, but, realizing that I'm trying to pay off my student loans and it's helping me out with a retirement.
Yeah, I don't mean to be so cynical to say, oh, here's legislation. Who was the lobbyist involved? Like, who does it really benefit? But I don't know. Through this conversation, that became apparent to me.
Is there a lobbyist for big business?
Yes.
Just,
and if they're hiring, hit me up. I'll be glad to come join you.
Yeah, I also assumed that it was sort of like industry specific, but just could be for just big businesses. We need help battling the small businesses.
Yeah, exactly. Yeah. The big business is terrified of 7-person companies.
I work for a small business and,
I own a small business. I feel you.
Yeah. How do you feel about not being targeted for some of these?
Yeah. I feel forgotten.
Okay. Well, good. Well, this is about as much as my brain can handle. So I'm gonna sign off. Anything you want to add?
No, I think we're good to go. Always good to be with you. And I'm just going to think about your son getting a billiards scholarship to MIT. I think that's the path. Hey,
look, man, you want to talk about STEM? I will show you how we play billiards on the diamond system.
Does that mean when you guys have cookies at your house, you have snooker doodles? Oh, I blew the joke by pronunciation. Ooh. Snooker doodles is hard to say, everybody. Well, all right, that's enough of me.
Candy is a whole other issue. Well, great. Well, thanks so much for your time, bud. I will see you in a bit.
My thanks again to Peter Dunn. As it happens, the lead story in IBJ's focus section this week is about the consumer rush to the safe haven of savings options that are paying 4% and 5% interest, at least for now. You can find it in the print edition of IBJ or online at ibj.com. And before you get on with your week, there are a few other stories in this issue that I want to bring to your attention. First up, founded 25 years ago, Cunningham Restaurant Group is on the verge of opening its 40th eatery and 16th distinctive restaurant concept, ranging from crowd pleaser Brewburger to downtown Zavita, which is the only Central Indiana restaurant to earn AAA's 4 Diamond Award. Dave Lindquist pulls back the curtain on the next phase of Cunningham Restaurant Group's expansion plans. Also in this week's issue, Peter Blanchard reports that the Indiana Economic Development Corp has been paying a huge premium for the farmland it's buying in Boone County for the LEAP Lebanon Innovation and Research District. And John Russell explains the debate brewing over how Indiana utilities will pay for transitioning to green energy. You can find these stories in the latest print edition of IBJ or online at ibj.com. I will say that it is easier to access all of the latest local news about business and politics and all of IBJ's data about Central Indiana's business, community, and economy if you're a subscriber. And you may not know that we have wrapped all of IBJ's content together now with all of the stories, columns, and podcasts from our sister publication, Inside Indiana Business. And that works out to just about $3 per week for actionable information about every notable business development across the state. You won't find Indiana's story told with this kind of breadth and depth anywhere else. Just go to ibj.com and click on that subscribe button. And thanks again for making time this week for the IBJ podcast. I'm Mason King. Hang in there, everybody. We'll be back again next week.